Inflation, it's a word that strikes fear into the hearts of many. The mere mention of it can cause anxiety and concern. But what exactly is it? Simply put, inflation is the rate at which prices for goods and services rise over time. It's an economic phenomenon that affects everyone. Think about it like this. Last year, you could buy a loaf of bread for $2. This year, that same loaf of bread costs $2.50. The increase may seem small, but it adds up over time. That's inflation at work. It's the silent thief that slowly erodes the value of your money. Now, a little inflation is normal and even healthy for a growing economy. It encourages spending and investment. But when prices rise too quickly, it can erode our purchasing power and make it harder to make ends meet. This rapid increase can be devastating for many, and that's exactly what we're seeing today. The rapid rise in prices is affecting everyone. From groceries to gas to housing, the cost of living is rising at an alarming rate, and many people are feeling the pinch. It's becoming increasingly difficult to keep up. This rise in inflation is due to a confluence of factors, including supply chain disruptions, increased demand, and government policies. Each of these elements plays a significant role. Whatever the cause, the effects are being felt by everyone, from everyday consumers to large corporations. No one is immune. It's more important than ever to understand inflation and how to protect ourselves from its erosive effects. Knowledge is our best defense against this silent thief. Inflation doesn't impact every sector of the economy equally. Some sectors, like housing and commodities, are particularly vulnerable to inflationary pressures. Let's take a look at how these sectors are being affected. Housing costs, a significant portion of most household budgets, have skyrocketed in recent years. This surge is driven by a combination of factors, including rising material costs, limited housing supply, and increased demand. For many, finding affordable housing is becoming increasingly challenging. Commodity prices, which encompass everything from oil and gas to wheat and corn, are also on the rise. This increase directly impacts the cost of essentials like transportation and food. For families already struggling to put food on the table, these rising costs can be devastating. The uneven impact of inflation highlights the need for targeted solutions. While some sectors thrive, others struggle to stay afloat. Understanding these nuances is crucial for making informed financial decisions in an inflationary environment. Governments play a crucial role in influencing inflation, a key economic indicator that affects everyone. Through their monetary and fiscal policies, they can either stoke the flames of inflation or help to keep them in check, depending on the economic climate and the decisions they make. One of the primary tools at their disposal is interest rates, which can be adjusted to influence borrowing and spending. By raising interest rates, central banks can make it more expensive to borrow money, which can help to cool down an overheated economy and curb inflation. Conversely, lowering interest rates can stimulate borrowing and spending. Another tool is government spending, which can be directed towards various sectors to stimulate economic growth. When the government injects money into the economy through stimulus packages or infrastructure projects, it can boost economic activity but also potentially lead to higher inflation if not managed carefully. Finding the right balance between stimulating growth and controlling inflation is a delicate dance that requires careful consideration and a steady hand, as both aspects are crucial for a healthy economy. However, government policies are not a magic bullet and cannot solve all economic issues instantly. They operate within a complex web of global economic forces that are often beyond their control, making the task even more challenging. Factors like global supply chain disruptions, geopolitical events, and changes in consumer behavior can all impact inflation, regardless of government action, adding layers of complexity to the already intricate balancing act. In the face of rising inflation, your greatest asset is your earning power. What exactly does that mean? It's your ability to generate income through your skills, knowledge, and hard work. The higher your earning power, the better equipped you'll be to navigate the challenges of a rising cost of living. So how can you increase your earning power? It starts with investing in yourself. This could mean pursuing higher education or vocational training, developing in-demand skills, or simply becoming more knowledgeable and efficient in your current role. Never underestimate the power of hard work and dedication. Continuously seeking ways to improve your skills and add value to the marketplace will serve you well. especially during times of economic uncertainty. Remember, your earning power is your best defense against the silent thief of inflation. Investing wisely. A beacon in the storm. Investing wisely is crucial for protecting and growing your wealth, especially during periods of inflation. But with so many investment options available, it can be overwhelming to know where to start. Don't worry, we'll break it down into simple, actionable steps. First and foremost, focus on strong, well-established businesses. Look for companies with a proven track record of profitability, strong brand recognition, and a durable competitive advantage. These companies are like sturdy ships that can weather economic storms and continue to deliver value over the long term. Don't get caught up in the hype surrounding the latest investment fads or get-rich-quick schemes. Instead, focus on investing in quality companies with solid fundamentals. Remember, slow and steady wins the race, especially when it comes to building long-term wealth. Staying within your circle of competence. One of the most important concepts in investing is the circle of competence. This refers to the areas where you have a deep understanding and expertise. It's essential to recognize your limitations and avoid investing in things you don't fully comprehend. For example, if you have a deep understanding of the technology industry but know very little about the energy sector, it's generally wise to stick to investing in technology companies. Trying to invest in areas outside your circle of competence is like navigating uncharted waters without a map or compass. By staying within your circle of competence, you're more likely to make informed investment decisions based on sound judgment and avoid costly mistakes. Remember, it's better to miss out on a few opportunities than to lose money on investments you don't understand. The importance of temperament and rationality. When it comes to investing, your temperament is just as important as your intellect. In fact, some would argue that it's even more important. Why? Because investing is not just about crunching numbers and analyzing data. It's also about managing your emotions and making rational decisions, even when the markets are volatile. Fear and greed are two of the most powerful emotions that can lead to poor investment decisions. When you let fear dictate your actions, you might sell your investments at the worst possible time, locking in losses. Conversely, when greed takes over, you might chase after risky investments, hoping for a quick profit, only to end up losing your shirt. The key to successful investing is to develop a disciplined approach and stick to it, regardless of what the market is doing. This means having a well-defined investment plan, diversifying your portfolio, and avoiding emotional decisions. Learning from mistakes. The LTCM Collapse. The collapse of long-term capital management, or LTCM, in 1998 is a cautionary tale about the importance of risk management and the dangers of overconfidence. This event shook the financial world and left a lasting impact on how hedge funds operate. LTCM was a hedge fund run by some of the brightest minds on Wall Street, including Nobel laureates. These individuals were considered the elite in their field, bringing a sense of invincibility to the fund. They used complex mathematical models to make highly leveraged bets on the markets. These models were designed to predict market movements with high precision, but they had their limitations. For a while, everything went according to plan, and LTCM generated spectacular returns. Investors were thrilled, and the fund's success seemed unstoppable. However, their models failed to account for the possibility of a major financial crisis, like the one triggered by the Russian government's default on its debt in 1998. This unexpected event sent shockwaves through the global financial markets. When the crisis hit, LTCM's highly leveraged positions quickly unraveled, and the fund collapsed, requiring a $3.6 billion bailout from a consortium of Wall Street banks. The speed and severity of the collapse were unprecedented. The LTCM debacle teaches us that even the smartest people can make mistakes, especially when they become overconfident and fail to properly assess risk. It serves as a powerful lesson in humility and caution. It's a stark reminder that no one is infallible, and that risk management should always be a top priority. In the world of finance, vigilance and prudence are essential to avoid catastrophic failures. Navigating the seas of change. We live in a world of constant change. The economy is evolving, technology is advancing at an unprecedented pace, and new challenges are constantly emerging. Navigating these turbulent waters requires adaptability, resilience, and a willingness to learn and grow. One of the most important things you can do is to stay informed about the latest economic trends and investment opportunities. Read books, listen to podcasts, attend seminars, and don't be afraid to ask questions. The more you learn, the better equipped you'll be to make sound financial decisions. Remember, the journey to financial security is a marathon, not a sprint. There will be bumps along the way, but by staying focused on your goals, making informed decisions, and seeking guidance from trusted advisors, you can weather any storm and achieve your financial dreams.